going to do is I'm going to kick it over to the Huxley group, and they'll take us through the market. And then we're going to do some kind of thoughts from the summer. And with that, one thing I do want to say is we are recording this call. So if that makes anybody uncomfortable or anything like that, you can obviously drop the call, but if you also want to just stop your video, that's another way. Q&A will also be recorded. So to the degree that that's a consideration for asking questions, I just want people to be aware of that. And with that being said, interns in the lab, let me kick it over to you.
Okay, welcome everybody to the final Huxley Capital Market update of the summer, titled Rallies, Risk, and Rotation. My name is Rhett Newton. I will kick us off in the macro section of the presentation alongside my colleague, Ariana Robinson. So we'll start off by taking a look at the Huxley portfolio. We have not made any changes since the last time we talked, but for those who are new to the call, I'll walk you through it. Our portfolio holds about 41% S&P, 5% a momentum ETF, 5% Russell 2000 small caps, and 5% real estate. Taking a look at the fixed income section, we have about 15% investment grade bonds, 11% senior loans, and then we have a small allocation in 3-year treasuries, 10-year treasuries, and a TLT ETF, which is long dated treasuries. When you're taking a look over the past month, we've had a pretty good month, outperforming the 60-40 benchmark by about 86 basis points. A lot of this outperformance can be attributed to the recent rally in small cap stocks alongside real estate. Russell 2000 small caps up about 10% over the last month, and our real estate ETF IYR is up about 8%. So last week's big economic release was the PCE number, which is the Fed's preferred measure of inflation. This number headline came in a little higher along with core. Headline was 0.1% month over month. The expected was 0%, and the core month over month came in at 0.2, slightly above the 0.1% expected. When taking a look at year over year, the core was 2.6% and headline was 2.5%. So showed further progress toward reaching the Fed's 2% target goal of inflation, but it didn't really change the sentiment around what the Fed will do, as I'll talk about on the next slide. So today, the Fed was meeting, and they are releasing their economic policy as we speak, followed by Jerome Powell speaking at 2:30. We expect to see no change in policy for this month, but a rate cut is expected in September. Another central bank that is looking at a cut by the end of the year is the Bank of England. They are meeting tomorrow, and it's pretty split whether there will be a cut at this meeting or their next one in August. And then taking a look over at Japan, they also met today. They increased their benchmark interest rate to 0.25%, up from a range of 0 to 0.1% previously. Alongside that, we've seen the yen strengthening within the last couple of weeks. The Bank of Japan has spent over $36 billion to shore up the price of the yen over the last month. And with the Japan-US interest rate differential decreasing, the yen has strengthened to a 3-month high. Now I will pass it over to my colleague, Ari.
Thank you, Rhett. So my name's Ari Robinson, and I'll be taking you through the remainder of the macro portion. So first, we wanted to give you guys a VIX update. We talked about volatility last week and how we've seen a recent spike in volatility. Last week, we saw it at 17.5, and since then, we saw a peak of 19.18 on July 25th. Since then, it has started to climb down, as you can see on this graph, and it's currently at 16.27. And now we'll go into the fixed income portion.
Thanks, Ari. My name's James Browning, and Ty Longo and I are going to bring you through the fixed income portion of today's presentation. So starting off, since it's the last update, we wanted to show you guys the difference in the yield curve from May 28th, our first day, until now. So on the bottom in the bright green is today, and in the yellow dotted line was May 28th. It somewhat looks like the yield curve is less inverted now, but we go by the metrics of 2s and 10s. And when we got here, the 2s and 10s spread was negative 43 basis points, and now it's negative 23. So the yield curve is actually starting to normalize, and it's a little bit less inverted than when we started. And then going over last week's curve changes, you can see the 2-year was the biggest mover, going down 13 basis points, and the 10-year was also a bit of a mover, going down, the yield going down 5 basis points. We're positioned in the 10-year, the 3-year, and the TLT ETF in the portfolio. So this change in yield last week was beneficial to all those positions.
Thank you, James. My name is Ty Longo, and I'll take you through the remainder of the fixed income section. So in terms of the credit market, we like to look at specific asset classes with fundamentals, valuation, and technicals. And we're very bullish on the fundamentals and technicals in the credit market, and we're negative on the valuation. So here we have a graph of the outflows from the money market funds into the credit market. So we've seen a lot of funds exit the money market instruments and go into bank loans and corporate high yield. And then also with rate cuts starting to fall, you see a lot of these bond investors start to prioritize, or sorry, not bond investors, but investors prioritize bonds instead of other instruments. So in terms of the fundamentals, we're very bullish on it for a couple of reasons. First is bonds are paying the highest yield that we've seen in a generation. We also have the sense that the Fed is going to start cutting rates. Jerome Powell spoke today, and there's also a very high likely chance that they cut in September. And I think swap traders are pricing in maybe even 3 rate cuts now. I know it's at least 2. I think it's around 2.5. And then also we've seen $150 billion of inflow into US fixed income ETFs through July, which is a record through this point in any year we've ever seen. So in terms of the valuation, we're generally negative on valuation for a few things. Credit spreads right now are at or near historical tights. As you can see from the graph, we're currently at 215 basis point differential between the spread on high yield bonds minus investment grade, which compared to where we've been historically is close to historical tights. So evaluations have been very full. The credit market's been kind of hanging in there throughout the duration of the summer, and we like credit, but the valuations are very full. And finally, on to issuance, we're very bullish on the technical side of things with supply and demand. In terms of last week, 55% of the new issuances traded tighter after they hit the market. We've seen jumbo deals from United Healthcare, which went to the market with $12 billion of issuance, and then Occidental Petroleum, which went with $5 billion. This week, we're expected to see $25 billion of issuance. We saw just over $13 billion yesterday, and I believe just over $8 billion yesterday, with Netflix coming with $1.8 billion and Citigroup came with $4 billion, I believe. And we're very close to a record of 123 billion, for the month of July. We're at around 119 billion, but with the Fed meeting today, no one hit the market. So we're gonna end up falling just short of that record. But we've seen really, really good demand for that Netflix and Citigroup deals. I believe there was about $20 billion worth of demand for the Netflix bond, and for Citigroup, it was around 10 billion. So we've seen the market be very healthy and a lot of demand for new issuances coming to the market. And I'll pass it on to the equity section.
All right, thanks, Ty. Hello, everybody. My name is Nate Faria, and my colleague Colin Trace and I are going to take you through the rest of the equity section. So breaking down fundamentals, valuations, and technicals for the stock market. We're pretty bullish on fundamentals. We've watched GDP come in about in line with expectations once you take out inventories. And just year to date, markets are still up significantly. We start to see a rotation into different equities, but still strong equity performance year to date. In terms of valuations, we're pretty bearish on valuations because the S&P is trading at a pretty high multiple relative to the past 5-10 years. I think it's trading about 21.5 right now, and normally it should trade around 18. So we're bearish on valuations. And then in terms of technicals, there's not a lot of IPOs going on in the market. There's not a lot of M&A deals going on. There are some stock buybacks, but we're pretty neutral on technicals. So as I mentioned, there's been a significant rotation going on in the market out of the large cap beta stocks and in the more small cap stocks, which are more interest rate sensitive. So as you can see, There's been some interesting returns in regard to the NASDAQ and S&P, with the NASDAQ Composite NASDAQ 100 down 2.5% and 3.5% respectively, and a switch into the Russell 2000. Russell 2000 is up about 12.1% in the past month, which makes up most of its year-to-date returns at about 12.34%. There's also been a decline in the S&P in the past month and even past few days, down about 0.83%, 0.26% respectively. And to continue with that rotation dynamic going on in the market, we've seen some interesting outperformers, and this includes regional banks, builders, and as I mentioned, the S&P, or not the S&P, apologies, Russell 2000. Regional banks might be recovering from harsh year-to-date performance because of talk going on about commercial real estate, and so they might be correcting from that. Meanwhile, downward movers include, surprisingly, tech and consumer discretionary. If you've been on a call before, as you know, there's been a lot of talk about tech in the market with stocks like NVIDIA, Supermicro Computers up crazy numbers year to date. And so it's been an interesting dynamic, especially in the past few weeks. And I think the chart on the right shows just the discrepancy between the Russell 2000 and the S&P. For the S&P to be down over the month and the Russell to be up a significant portion, about 6.5%, is definitely interesting. And then looking at specific sectors, as I mentioned, technology has not been doing well over the past week, actually recovering today slightly. More interest rate sensitive sectors such as real estate and utilities are up, as well as industrials and healthcare, which might play more into that rotation dynamic. And consumer discretionary is down. This has been interesting. There's been some interesting dynamics going on with consumer, which we saw through some earnings reports from Visa and other consumer discretionary companies. And now I'll hand it off to my colleague, Colin.
Thank you. So now we're going to do a deep dive into how the earnings season has gone so far. So earnings season, or going into the earnings season, we had projections of earnings hitting 8.9 year-over-year growth. And now that we're in the thick of earnings season for the second quarter, we're looking at a projected growth rate of 9.8 year-over-year growth. And this would be the highest year-over-year growth reported in the index since the last quarter in 2021, which is a good sign for the market. So now just under 50% of the S&P 500 has reported earnings so far. And of those 50, we have 78% of the S&P companies have beat or had a positive EPS surprise. But out of these surprises, earnings are only growing about 4.4%, which is above expectations, both on the 1, 5, and 10-year average. But looking at what happens when they miss, stocks are being punished much more severely when their EPS is not exceeding expectations. On average, companies are selling off about 5.2% over the 2 days after their earnings, which is double their normal average when missing earnings. So what's going on with tech and AI? So we saw a few notable names report this week and last week. We have Alphabet reported earnings Wednesday and beat on both last Wednesday and beat on both EPS and revenue, led by their advertising section. But they traded down on Thursday due to an extra $1 billion spent in CapEx. And this mostly went towards AI and areas like that. Microsoft also released yesterday after hours and slightly beat on revenue and EPS, but also traded down after hours. They traded down due to a miss in revenue from Azure cloud computing, and which has some correlation to AI. And then also they are projecting to increase spending on AI because they were not meeting the demand that the market was setting for them. And this kind of shows a big pivot in the market's mindset and the investors, because we're starting to see investors want to see a return on the AI investment, not just that they're putting money into it. So looking at this week's earnings calendar, we had some notable names. McDonald's, beginning of the week, missed on both revenue and earnings per share, but we kind of saw that coming with negative guidance given by them. On yesterday, we saw Microsoft, Procter & Gamble, AMD, Pfizer, Starbucks. Microsoft beat on both revenue and EPS, like I talked about on the last slide, and still traded down, missed on some crucial indicators for the market. Procter & Gamble beat revenue but missed on EPS. And then AMD beat on both sale, and they said their sales doubled. And due to this, we saw a huge surge in semis today. Both NVIDIA, AMD, Broadcom, all trading upwards of 7 or 8%. Now looking towards this afternoon, we have Meta, Qualcomm, MasterCard, Boeing. Should be an interesting one to look at. And then Thursday, 2 big names, Apple, Amazon. We'll see how they come out as they're part of the Magnificent Seven and have been leading the S&P at least this half of the year pretty strongly. And then Friday, we got Berkshire Hathaway, ExxonMobil, and Chevron. A little look into the energy sector. So looking ahead to next week, we have not a ton of notable names. Airbnb, Simon Property Group on Monday. They're a big mall owner. Wednesday, Disney, Shopify, could be an interesting look into the consumer. Same with Coca-Cola. And then Thursday is a big name for GLP-1 drugs. Looking at Eli Lilly and Novo Nordisk. And then Friday, not too many notable mentions.
All right, and then here we have the economic calendar for this week. On Tuesday, we have the JOLTS number and the consumer confidence number come out. JOLTS came in at 8.184 million and consumer confidence came in at 100.3. Today we have the Fed meetings on the rate decision where the market is not expecting a rate cut. And as Rhett mentioned earlier, we have the Bank of Japan meeting where they decided to raise rates to 0.25%. Tomorrow we have initial jobless claims and a meeting from the Bank of England. And on Friday we have the unemployment rate and the non-farms payroll number, which is expected to come in at 175,000. And there's no treasury auctions in the market this week. However, next week there will be treasury refunding of 3-year notes, 10-year notes, and 30-year bonds. And given that this is our last week of the Huxley Capital Market Update, we wanted to give some summer takeaways. So we'll start with what we changed in the portfolio since when we got it, as well as each team going into their highlights. All right, so here we have the portfolio construction of the original Huxley Capital portfolio and the current portfolio. So in the original portfolio, we had 11% in cash, 15% in small cap, 5% in real estate, 9% in high yield, 4% in senior loans, 41% in the S&P, and 15% in investment grade. And as Rhett talked about earlier, our current portfolio is a lot more diverse than that. So what we've changed, we decreased our cash position, we got rid of our position in high yield, we lowered our position in small cap, we increased our position in senior loans, added a momentum ETF, added 10-year treasuries, added 3-year treasuries, and added a TLT ETF, which is for bonds with maturities with 20 plus years remaining. Doing this, we increased our duration. We came in with a duration of 3.94, and currently our duration is sitting at 6.13. And over this time period, we have outperformed the 60-40 benchmark by 86 basis points. Another thing we have been looking at this year is the Fed rate cut probabilities. So when we first came in here, the probability for a cut in July was 12%, and in September it was 60.5%. And now the July probability is a lot lower than that at 3.1%, with an almost 100% of a cut in September. And although we were told the summer would be quiet, that definitely did not happen. We have a lot of things going around worldwide. In France, we had Macron calling a snap election, which caused extreme volatility and uncertainty in France. It caused the German and French bond spread to widen to 81.5 basis points on June 27th. And the spread in the bonds is now currently sitting at 71 basis points. In Japan, we saw the Japanese yen weaken severely over the summer. It weakened to a high of 161.69 yen per $1 US. And due to the weakening, the Bank of Japan intervened. They utilized 36 billion yen to help strengthen their currency. And now the yen is priced at 115.15 yen for $1. And we also saw a lot going on in the US. We saw a Trump trade with positives for banks, financials, oils, and crypto. And there was an unfortunate assassination attempt on former President Donald Trump. This raised his favorability in the election versus Biden, which increased that Trump trade, as we saw. President Joe Biden dropped out of the presidential race, and he endorsed Vice President Kamala Harris to be the candidate for the Democratic Party. And now we'll go into the fixed income highlights.
Yeah, so for the fixed income summer highlights, I'm going to reiterate a bit of what I said earlier and what Ari just said. But we made some trades, as you can see on the bottom, to increase our or to lengthen our duration across the curve with the 3-year, 10-year, and the TLT ETF. We also overweighted ourselves in credit with the addition of senior loans. And as Ari mentioned, we reduced our positioning in cash and we completely sold our position in high yield. Looking at issuance, we had a huge summer of treasury issuance, as well as a big summer in investment grade and high yield issuance. As you can see on the charts, we had 130 billion in May for IG and 102 billion. Oh, sorry, 102 billion in June and almost 120 in July. And high yield was pretty big too, with 31 billion in May, 17 billion in June, and 19 in July. The spreads have been tight and pretty range bound all summer, with lows of 85 and highs of 95 in the IG spread. And the same story in high yield credit market, pretty range bound, ranging between high 200s and about 313 to 315. Finally, you can see in the top right, the yield curve, or yields along the yield curve had dropped throughout the summer, with the short end dropping more than the long end.
Okay, now we're gonna go into the equity story throughout our internship. So going into when we started our internship, the main story and driver in the market was AI. Big tech was really pushing the market forward. S&P had very little breadth. Only about a handful of companies were driving the returns that you see at 11% year to date. We see the NASDAQ heavily tech was up 13, and momentum also pretty heavy semis was up 22% as we came in on May 28th. Really pushing the AI story. That was what was driving the economy or the market. And we see the Russell and real estate really were not having a great time during then, lagging behind by quite a bit. But now we've seen, when we talked about a total transition into the market right now, we've seen breadth widen. We've seen big tech kind of sell off recently. Little boost on tech today, but for the most part, we've seen a sell off the last few weeks. We see the Russell had rebounded quite a bit, looking at 9.08% right now year to date. And real estate huge, going from -7% to up to 12.17% while we were here in the 10 weeks. And both the Russell and real estate were some of the big reasons why we were able to beat our benchmark, even with our momentum trade not working out.
Okay, and then looking at another interesting dynamic we've witnessed in the market, especially in the past couple of weeks, has been, as Colin mentioned in the earnings report earlier, how punished some companies get for missing their earnings. We watched Walgreens plummet significantly after some issues going on with the consumer and maybe some market share being taken by Amazon. Dexcom just a few days ago released an earnings report, significantly missing because of potentially GLP-1 drugs taking market share, and down 42%. I mean, that's brutal. Lululemon has also been down significantly year to date with some difficult earnings reports, as well as some questions about how strong the athleisure market is. And then Intel is the surprising loser compared to NVIDIA, Supermicro Computers, and even now AMD surging. Intel has lagged behind significantly, down 28% in the past few months. So certainly an interesting dynamic going on, and something we've had the opportunity to witness while we're here at Huxley. Now I'll pass it off to questions.
Good. Nice job, everybody. Before we get into Q&A, I wanted to a couple things. Actually, I'll do it after. I'll do it after Q&A. So, real quickly, what is a trade that you guys feel like you missed? Right, performance is good. You know, we sit around in a trading room, but which ones you're like, you know what, we should have done that. We talked about it. We didn't have the gumption to do it, or we weren't sure the information. What are the ones you're like that one got away?
So I think one thing that we kind of grappled with all summer is where do we want to fall on that duration curve almost. So coming in, we were just about 4 years, which was significantly short of our benchmark of around 8.25 years. So we decided to lengthen it over the first couple of weeks, bring it to about 6.2, 6.3, I think. And then there were some talks, should we add some duration, maybe out on the longer toward the longer portion of the curve, or do we want to push that towards the shorter portion of the curve? But we decided I think maybe we were a little bit influenced by that Trump trade going on right after the unfortunate assassination attempt, that we thought maybe that the long end of the curve would balloon upwards if he were to be elected due to the tax cuts and the tariffs. So I think we positioned ourselves on the 3-year portion of the curve. But I think knowing now, I think maybe we should have extended, but hindsight's always 2020. You don't know how that would have worked out. So overall, I was happy with our performance though.
Anything on the equity side?
So I think originally we were when we received the portfolio, we were holding a lot more small cap, and I think as an equity group, we were pretty bullish on small cap in the long term, seeing that they were trading well below their average and the S&P was trading well above its PE average. We really liked it, but over the course of the first few weeks, seeing us just lag behind the benchmark because of small cap and real estate, it was tough to watch, and I think that's why we kind of wanted to jump on the low breadth AI market with the momentum trade, which worked for a little bit, but we didn't exactly time it too well and kind of caught the very end of it and got swept up in the reversal, but which actually ended up helping us and helped real estate and small cap. But I think if we were a little more patient, willing to ride out the market, it would have helped us. And I don't know if we would have gone along with the momentum trade. I think we would have kept more capital in small cap.
Fair enough. Those are hard. I mean, those are real issues that every manager faces. Let me open it up broadly. I've got a couple more, but I want to make sure that other people have a chance to get in.
Hey, Paul, I have a quick question. I'm just wondering, from the group's perspective, doing this Wednesday call at 2:00, I think this is probably the 6th call that you guys have done. Do you feel as though presenting on a sector basis is that kind of richened the learning process for the team?
Thanks, Kurt. I would say it is. I think seeing how the macro team going first allows everybody to see how the macroeconomic environment plays into their specific sector. And I also, I think it's interesting that we do it on Wednesdays in general. It becomes a little difficult when sometimes the stock market can move rapidly, especially when volatility picks up. And, by Monday after we work on the presentation all weekend, things have changed on Wednesday. But I do enjoy the setup. And I think even with the rotation dynamic that has gone on because of the sentiment around interest rates changing, going from macroeconomic environment to fixed income, how yields have changed, and then seeing that play into the rotation trade that's going on in the equity market has been real fruitful to witness.
Other views on that? Well, actually, I have a question from CJ Corey. Now that you beat the benchmark in your portfolio, would you change any of the trades you made? So this is almost the question, what would you do now? A great question. Thank you, by the way. I love that students are weighing in. Thank you. Did you hear me? What would you do now?
We're figuring it out. So it's a little difficult to hear in here. I think some of us might, or at least in my case, I would position us maybe a little more defensively, especially since we're leaving and this is kind of turning into a passive fund as we leave. Well, at least I'd assume. Some of our time horizons for trade, such as the momentum trade, was short term. If we were going to leave this for a longer term, we might move out of our momentum trade and into the S&P. Maybe even try to capitalize on the breadth opening up in the market and buy some equal weight S&P. I don't know if anybody else maybe some fixed income trades.
I think something also too that we're looking at is the financial sector. If President Trump does end up winning that election, we think that IPO market can start to heat up again. We also think that M&A might become a little bit easier. So we think those investment banking fees could go up. Also, with the lowering of rates, we are bullish on the big money center banks. Not as much the regional banks. We're a little bit concerned with the state of the commercial real estate market right now. But we do like the big money center banks, and therefore I think we look at maybe XLF, the financial sector ETF.
So one of the things that that you guys were sort of tasked with at the beginning of this program was to look at a portfolio as a 60-40 equities and fixed income, and there are certain limitations as to asset classes that were acceptable to be included in the portfolio. But if there was one asset class that you wish were available for investing for the Huxley Capital team, what would that be?
So one of the great things about this summer is that we've been fortunate. We each did a project, and then we kind of spoke on kind of maybe like a lesser known asset class, and I think we heard a lot of really good options. I think, and then also we had somebody come in and kind of speak to us about cryptocurrency, and maybe just a 1 or 2% Bitcoin allocation would help us out. I think we need to do a little bit more research on it, but that is definitely an interesting concept. Also, somebody did a presentation on cat bonds, and we're not fully sold on it yet, but there are supposed benefits. We're still trying to figure all that math out, but just maybe something on those lines, maybe something a little bit outside the realm of what's considered normal in a traditional 60-40.
I'm going to do a little bit of a break off in Q&A. So we actually have a couple things going on. So we actually have, I want to make sure, I don't think, I might embarrass, she's technically my new boss. But Chris Early, who's the new interim dean of the business school, is on the call. Chris, there you go.
Yeah, I'm here.
You're seeing Huxley live in the flesh.
Yeah, this is great.
So welcome aboard, by the way. And you're kind of getting a feel for what the kids are doing. And then we did have 2 awards we give out. So generally, and I'll speak for Matt and Kurt and Ed and Sylvia and Artie and different people who helped out. I was really pleased with the work of all the students from the beginning. But in the special projects, we had the students vote or the interns vote, and then also kind of with some oversight from the advisors, although we did agree with the choices. We gave 2 awards. So one of the awards was for kind of best research in a project. Almost call this our high degree of difficulty dive award for presentation. And that goes to Ryan Varley. And Ryan did his presentation, which he was being irreverent on catastrophe bonds, or kind of the reinsurance vehicle that is cat bonds, and did a great job. So that was one of our awards. And then kind of the best presentation, and I just say kind of complete from beginning to end, went to Ari Robinson, who went through the emerging market debt vehicles. So I broke a little bit from the order, but I had to respond to that nascent cat bond allocation comment, Ryan. But all the projects were really good, and I hate to say surprised me, to the upside, but that is the truth. And there was other votes that were given, but that was great work. Last question I'm going to ask people. What was the most interesting thing, and you don't have to do all 10 of you, but most interesting takeaways from Huxley, and what you learned this summer, what you did, or maybe what you didn't learn, but most interesting aspects?
One thing that I thought was really interesting, and I think because of the environment we were in and the advisors we had, we were able to learn this, was looking at different speakers and different people on the news, talking about the market, what they think about the market, and breaking down maybe why they believe what they believe or their bias. For example, maybe someone in commercial real estate thinks Jerome Powell, Fed Chair Jerome Powell is doing a poor job, but that's heavily affecting his industry, or somebody's on the sell side of the market and this is their product, so maybe they have a bias towards advertising it to the public and using an opportunity, say on CNBC, to do that. So I thought that was really interesting and something that I wouldn't be able to break down on my own, and so being here allowed me to do that with the advisors.
So what you're saying, we made you skeptical and jaded. What other things?
Yeah, so the thing I found the most interesting was just taking a deep dive into fixed income. Coming into Huxley Capital, I didn't really know the relationship between interest rates and bond prices and all that stuff, but just learning about like duration and how the relationship between duration and rate sensitivity goes into pricing a bond. I thought that was really interesting and like something that I definitely took away from Huxley Capital, and I think will be very useful in the future in my classes and possibly future jobs.
Yeah, and what's interesting, and Chris, this is something I'm gonna talk about. So our faculty, and Matt Callahan in particular, in his fixed income class, spent a lot of time on that. There's nothing like repetition in front of screens and markets and kind of looking at spread widening and new deals. It just kind of locks in and seals it in. What else? So two more.
So I'd say, like, I didn't really know too much about the credit market coming in. I felt very comfortable with fixed income. I don't know if you want just like the whole fixed income market, but when looking at the credit market, I knew nothing about it. I didn't know where spreads were. I really didn't know. Like, I knew the general ideas, but in terms of like really specific stuff, I didn't know it. And I think it's been super interesting being able to follow the credit market, knowing how to follow it too through Bloomberg, seeing the new deals that are issued, what their spreads are, how does that compare to other companies that recently just issued, how's the demand for it, and what that can mean for the market. I think it's been very beneficial and something that I'll continue to do going forward.
I suspect you'll be doing that next summer. Very specifically. One last one.
Something I thought that was very interesting that I learned, and I think I'd only learn if I was sitting in front of the Bloomberg screen for 5 hours a day, is how fast the market is pricing in all the information that it gets. So whether that's, how many hours the Fed meets for, the non-farm payroll, all these things, whether or not someone missed expectations or beat expectations in terms of earnings, all that is priced in so incredibly fast. And you really have to be making trades ahead of what you think is going to happen in order to capitalize on some of the things. And then you have to be able to not get so caught up in like the day-to-day fluctuation of the ETFs or the bonds that we hold. Like a lot of that's noise, and you have to be able to look at the bigger picture, see where it's going, where it's like where is it trending, not just bouncing around minute to minute, hour to hour. I thought that was a pretty interesting thing to be able to observe and to take away.
Okay. Other questions from people before I do some final parting shots?
No question. I'm a friend of Kurt's. This first time that I've joined the call, and again, I think you guys have done a lot of work as a team, and it was really a great presentation. So thank you.
That's nice of you, George.
Thank you.
I'll do a couple parting shots. So we have one more day in Huxley tomorrow. We'll do some cleanup stuff. I want to give a huge thank you to kind of the Providence administration, so starting from the provost's office to Sylvia, for getting us off the ground on this. And then you can't get off the ground unless you have kind of, foot soldiers, to use a military analogy. And Matt Callahan and Kurt Morley who kind of got roped into this. Matt and I actually talked about this originally. I don't know, Matt, when we originally talked about it, if you envisioned being down here 4 days a week for 10 weeks. And Kurt went from adjunct to voluntary advisor to kind of opening the place up in the morning. So thank you both. We also had guest speakers, and I won't go through their names, but we ended up having 11 guest speakers, as well as one of our own faculty, Kevin McMahon, stopped in and kind of did our leadoff presentation. And Artie did stuff on behavioral finance. It was really great. And then a lot of we were fortunate enough to have people from Lisa Miller to Carolyn Duane arrange to feed us from time to time. And one of the things that Ryan Varley's made very clear is the Mediterranean Tuscan chicken is not his favorite item. But somehow that powered him through a very strong presentation. Matt and Ed, I'm going to give you a chance to do a quick sign off because you're involved in this as well. Ed, why don't I go to you because as head of the finance department?
Thanks, Paul. Yeah, I just want to say that I was incredibly impressed with the progression the students made over the 10 weeks. I think that they learned an incredible amount, and their professionalism is just really, really incredible. And I would add that it was such a pleasure to be in the room with Paul and Matt and Kurt, and just have that sort of back and forth. Really, really interesting teaching experience.
And Matt, I'll kick it over to you. And we're going to have to give Kurt some airtime too, because he got pulled in aggressively.
Yeah, he totally got pulled in aggressively and went in 110%. I think I'm going to take this opportunity to thank Paul. Paul is singularly responsible for, shepherding this from what was honestly a conversation that Paul and I had over a couple of beers back in December to having this 10-week program be what it was. And for those of you who, are from the academic sort of environment, getting an undertaking like this off the ground and actually be successful in such a short period of time is impressive. And I think it's Paul single-handedly took the baton and ran with it and got everything to the finish line. So I think everyone rightly deserves to give him lots of credit. And it was wonderful having all the interns as well. It's great being in the classroom throughout the year, but it was a extremely rewarding experience to be in a immersive, as real world as we can get on campus environment. And I think everyone hopefully got a lot out of it. And I know that I certainly did.
Hey, Paul, it's Kurt. Incredible experience. I remember in the organizational meeting back in April and early May, I commented that we were in an inverted yield curve environment and that students might not get an opportunity to see something like this for a long period of time. That was only one thing that I thought we had to deal with, but instead the students got what was typically a very, summers can be quiet. It was amazing the amount of information that they had an opportunity to digest over the course of 10 weeks. And I thought they did an amazing job. They hit on a lot of the topics in the call today that were really hot topics in the market. And this is the beauty of the markets. And I really commend the students because I feel like some of the commentary that I heard today from them on the call, they've gone through a growth period here where I feel like their acumen, their ability to talk about themes in the marketplace in a very rich, a lot of their answers now are really super thick, and that's great. And I think it's only going to help them in their careers. And I certainly benefited from being here as well. Good experience.
Good. Thanks. And I do want to thank the interns as well. Sometimes feedback was direct. Sometimes it was quick and direct. And hopefully everybody got anything out of it. Thank you so much. We've got one more day. We'll be doing some wrap up stuff. And thanks for all the students and people who jumped on calls. And it was fun being back on a trading desk effectively with my colleagues and the interns. With that, we'll sign off.
Well, hold on. From the students, on behalf of the students, we just want to say thank you to Paul, Kurt, Matt, Ed, and everybody who came in and spent some time with us. This experience definitely would not have been as rewarding if we didn't have like people who actually worked on trading desks. And I think everybody it felt like a trading desk every day. I know I was excited to come to work every day, which was awesome. And usually I don't even like dressing up, but I mean, I'm not saying I'm going to wear like a collared shirt to class now, but it was cool coming in and felt like we were actually doing something important instead of just showing up in sweatpants and slippers. So on behalf of us, thank you guys for helping us out all summer, and looking forward to see what happens the next semester.
Yeah, thank you guys.
Thank you.
Thanks, everyone. We're gonna sign off. Thank you, everybody.